We got an exciting video today. These are the videos on my channel that I truly enjoy putting together because there could be a potential stock in here that you don't know of. And if I could put something on your radar that may fit into your portfolio, then I've done my job. But without further ado, we are talking about the top dividend growers on the Toronto Stock Exchange. We're going to talk about three of my favorites that personally I don't own today, but because of this research, they are definitely on my watch list. So there is some criteria that I've looked at. You had to have grown your dividend in the past 10 years by double digits. I also wanted to see share growth of over double digits in the past 10 years as well. So stay tuned. We'll take a look at one at the end that could potentially be undervalued at today's metrics. But if this is your first time here, my name's Nick and welcome to Ways to Wealth. Before we do get into this video, I'd just like to say if you don't feel comfortable buying into individual stocks in your portfolio, make sure to contact a financial advisor. Whatever I say today is my own opinion, and these are my own thoughts as to what I'm doing personally with my money. So with that being said, let's get right into the first one, and that is Alimentation QUESTRADE, and this is a convenience store play. You've probably seen these as Circle K and QUESTRADE are all throughout Canada. They also have some other exposure, which we'll break down in a little bit, but just briefly, these are convenience stores. So let's take a look at the MD&A just to learn a little bit more about this company. So they are the leader of convenience stores in Canada. In the US, one of the largest independent convenience store operators. In Europe, they're a leader in convenience store and mobility retail business. Scandinavian countries they're in, Baltic countries they're in, they even have a presence in Asia. So definitely a wide, vast of array, a huge spread across the global economy, so it's not just affected by one area. They're definitely a merger and acquisition story. They do look to go out to buy other convenience stores that are already operational. As of 2023 of April, their network comprised of over 9,000 stores throughout North America, over 8,000 stores with road transportation fuel dispensing. Our North American network consists of 17 different business units, 14 of which in the US covering 47 states, and 3 in Canada covering all 10 provinces. So definitely a very large organization. And let's take a look at some of the numbers. So we'll jump over here to Stratosphere, which gives you a good visual indication of what's going on in that business. One of the first places that I tend to look is how that stock has performed over the past 10 years. So at this chart here, we can see the compound annual growth rate over the past 10 years has been 20.58%, which is incredible. It's definitely a great looking chart, but let's break it down a little bit further. We have revenue growth of the past 3 years at 9.9%, over the past 10 years at 7.29. So definitely very solid numbers there. We can also take a look that the dividend yield is relatively small, but I guess one of the highlights of this video that we'll get into is the fact that if you buy at today's value and they continue to grow that dividend, well, your dividend is growing as well. And it's definitely a great thing to have within the portfolio. Now, doing a further breakdown on how they've grown the dividend, we are able to see back to April of 2019. And we can see they've gone from 16 cents a share all the way up to almost 40 cents a share. Now, I know it seems relatively small, but you do have to take into consideration that they are using their free cash flow, the cash that they have within their business, to buy additional businesses and then grow their revenue or grow the top line from that perspective. And that's why you see the share price has grown so much, because they've been able to use their cash capital allocated in order to grow their business share price as well. The next one is definitely also a TSX darling. It's Transforce International. And if you're not familiar, just briefly looking into it, they have over 540 facilities, 24,000 employees, and 90 different operating companies within the brand. Now, not to drive the point home too much, but we'll take a look at the solutions that they provide. And you can see there's 4 main. You have package and courier, less than truckload, aka LTL, truckload, and logistics. So just to show you if you were to click into each individual product, they do offer what the year-to-date revenue is, what this business unit comprises of the total overall company. You also have some of the benefits, but you see the 4 different companies that they own that operate in this space. We'll jump over to the less than truckload and we'll get a better picture of just what LTL means to this organization. And we can see that it makes up almost half of their revenue. Scrolling down a little bit further, we can see the companies that comprise their LTL division. They also have an over-the-road division, which has a multitude of different companies. So this is also a merger and acquisition story. Not to drive too much into the details, I'll leave that up to you to do your own homework. They like to buy business units, add that into their organization, create economies of scale, and that's the way they grow. So we'll look at a little bit further just to give you a better indication of how big the company is. As of December 31st, 2022, the company had over 25,000 employees, and this compares to 29,000 as of December 31st. So a little bit of layoffs there, a year-over-year decrease of 3,700. But in terms of how big their fleet is, they had over 11,000 tractors, 38,000 trailers, and 6,900 independent contractors. So this is a very big company that they consider to be the biggest in Canada. May not be the biggest in North America, but that could potentially be what their growth mindset is. Jumping over to Stratosphere to check out some of the numbers, the first place we look to is how the stock has performed over the past 10 years, and the compound annual growth rate is 23.62%. We'll take a look at some of the revenue numbers. They've obviously done very well in the past 3 years at over 28%, and this is due to the fact of the whole supply chain crisis that happened throughout the pandemic. We can also see the dividend yield is also less than 1%. But realistically, we're going to break down these numbers just to see what the dividend has done. Again, data going back to December 2018, we can see they paid 64 cents a share. And then all of a sudden, if you fast forward to today, they're paying $1.32. So again, if you bought this back in April of 2018 or December of 2018, you're seeing your dividend grow. So you're actually getting more yield as time goes on. It's a lot different than a lot of the different other companies that trade on the Toronto Stock Exchange, like Enbridge, where your share price is staying stagnant. It goes up, it goes down, it's cyclical. They're not really focused on growing the business. It's more a dividend play. Whereas with these, it's about share price growth with a growing dividend. So again, I just want to make that of note, but definitely one that we are adding into our watch list. The third one is probably an underknown name in the Canadian market. It's a company called Savaria. Now this one is very interesting because as we look through the products, you can see what type of market that they're going towards. And that's the baby boomers that are reaching that retirement age, and the baby boomers that are lacking that mobility, that they need to add some of these products into their household in order to get around. So you see a lot of chair lifts, you see elevators. This is one that could be a play on a segment, on an age demographic that is moving into the later years of their life. Looking at the MD&A, we can see their global presence. Much like the first company, they definitely have a global magnitude here, spanning from North America, Europe, and even into Asia. So definitely a global enterprise here. And we'll read down a little bit further just to see what their strategy is, or a little bit behind the insights. And we can see some of the facts and figures that they've been able to pull. 77% of people that are 50 years and older want to remain in their homes as they age. 71% said their homes have accessibility issues inside and out. So as we read on a little bit further, in 2022, as the pandemic faded, healthcare institutions gradually restored routine services, and investments in patient care product were positively impacted. The global long-term care market is expected to grow at 6% compounded annually between now and 2030. In the US alone, over 24 million people are expected to require long-term care by 2030. So let's take a look at some of the numbers. So again, jumping over to Stratosphere here, looking at the 10-year chart, This one again has grown at over 20% in the past 10 years at 22, almost 23% compounded annually. We can see their 3-year revenue growth has been fantastic at 31%. Even going back to 10 years past, it's compounding at 27%, which is absolutely fantastic. This one happens to have a little bit of a higher dividend yield at 3.27%. So again, we're going to take a look at what they've paid, and we'll jump down here to the ratios to see the dividends per share. So tracking back to 2018, they've done 37, almost 38 cents a share. And if we fast forward to today, they're paying about 51 cents a share. So it is important to note that the payout ratio is a little bit high at about 90%, meaning that they're paying out just as much cash as they have. But the important point to look at is this is something that is not going away. People are unfortunately getting older, and something that you will potentially see more revenue growth. They just happen to have a little bit of a stagnant period in between this pandemic. But if we take a look at the modeling, I know I mentioned it before, these are very loose figures. There is an opportunity for you to go in and put in your own indication of where you think this company is going to grow. But if we go down to the current share price, we see that it was trading for about $15 a share. The implied share price based on the basic metrics that are in there is about $34 a share. So you're looking at a potential 100% increase in these stocks. Now, make sure that you do your own homework. Make sure you know how to use this tool. For me, I am still learning personally, but it is one that I'm definitely considering adding into the portfolio. And that is it. That is my 3 favorite stocks on the TSX that are growing the dividend, but also growing the share price. Let me know down below if you own any of these today, or let me know if you are seriously going to consider adding these into the portfolio. I know 2 of them are definitely popular, but the last one is not. And I hope you enjoyed this video. If you enjoyed this type of content, we cover this stuff all the time. We've covered the top ETFs, some of which I will link in the side description here. Make sure to go check out those videos. But I hope you all have a great week in the markets. Happy investing.